Hello, everyone. Happy Friday. Thanks for joining Hacking Your Round. My name is Nathan. I run a startup called Foundersuite. If you haven't been to the site, it's basically a CRM and other tools for startups that are raising capital. We launched it about a year and a half ago, and startups using it have raised over $500 million in seed and VC. Before doing Foundersuite, I spent 10 years as fractional CFO working with a lot of different companies. Some of them you've heard of, like Kickstarter, Clicker. And most of the work was helping them put together their pitch, their model, put together a target investor list, and then we go out and try and raise money. And about half the time we were successful raising money and half the time we failed. So this talk basically is everything I learned from 12 plus years of raising capital. First up is how not to do it. Hunter Walk is a VC here in San Francisco, and I like this tweet from a while back. Will you introduce me to investors is too broad to be acted upon. This is how a lot of founders approach the job of raising capital, is they just start asking everyone they know if they can connect them to investors, and that's too ambiguous to be acted upon. It's also putting the work of figuring out who to talk to on the shoulders of the other person, where really that's your job. When I was doing this as a consultant, startups would hire me to help with this, and I would put in 50 to 100 hours researching and building that target list. That's pretty typical. So here's how not to do it. Instead, I like to think about fundraising as, sales 101. If you've ever been in sales, especially B2B sales, it follows a pretty straightforward pattern, right? You build a list of leads, you qualify those leads, you engage with them, and ultimately you drive them to a close. And fundraising is just really another sales process. We can expand on this by thinking of it like a funnel, right? We talk a lot about building your investor funnel and working your investor funnel, and this is what we mean by this. From a high-level view, it's building that large list of potential investors. Then we screen, filter, and qualify that list. Then we find the right person. Especially if you're pitching a venture fund, you want to find the right person at the fund. You're not just pitching a fund. You need to find the decision maker, someone who can champion the deal. And then you're figuring out how to reach them. This is really important. It's all about the warm introduction. We're going to talk about that in more detail. Those introductions are leading to pitch meetings, hopefully progressively deeper dive pitch meetings. That leads to term sheet, hopefully, and once you get a term sheet, you get into due diligence. Sometimes that's the order is reversed. But basically what that means, if you haven't been through due diligence, it's a very deep dive into your business before they write a check. When we got a term sheet from our investor, I got a term sheet on Friday, and Monday they sent me the due diligence list, and it was like 130 items they needed, like access to my Google Analytics and customer references, personal references, articles of incorporation, all that stuff. Assuming you get through due diligence, you're selling shares of your company or doing a convertible note. But conceptually, it's the same, right? It's a sales process. We're selling shares of our company. And if we treat it like a sales process and break it into its step-by-step components, I find that it removes a lot of the frustration and chaos and stress that founders have when raising money. So let's break it into its step-by-step approach. Number one is to build the funnel. Especially at the seed round, you need a pretty healthy list in your funnel. I always tell founders you need at least 100 names on your target list, and realistically that's more like 150, 200 investors for most startups. When we raised our seed round, I pitched over 200 investors and ended up with 1 seed VC and 10 angels on my cap table. And so you can do that math. That's about a 5% conversion rate. And that's actually pretty typical. That also means you're getting rejected 95% of the time. That's also very typical. So, just further emphasizes why you need a good, healthy starting list. A couple places to build your funnel. AngelList is useful. There's 24,000, 25,000 investors on AngelList. You can search by a couple of criteria. Within Foundersuite, we're building out a database. We've got about 50,000 investors in there now. And the way to use it is we basically collected these lists of investors and then spent a couple thousand hours of Mechanical Turk collecting everyone's social links and little bios and then tag them by market tag and location tag. So to search by market tag, you have to think about your best market that's most relevant for you. Start typing it, pick from the drop-down menu, and location search is mainly by city. So you would search by, London, not UK. And then what you do is if someone catches your eye, they looks interesting to you, open up their LinkedIn page or their Twitter page or AngelList page, do a little more digging, a little more research on them. If they look good, you add them to your board. They don't get contacted. This is just building that target list. So that's Foundersuite. Oh, and also, we just started, actually late last night, uploading a new list of about 10,000 venture firms, and we'll be adding about 8,000 family offices and fund-to-funds. So this database is getting bigger and bigger. Crunchbase is another pretty good resource when building your target list. The way I like to use Crunchbase, you can search on it, but the way I like to use Crunchbase is actually by making a list of companies that are similar to mine, but not directly competitive. And then I go plug them, each of them into Crunchbase, and I see who funded them at the relevant stage I'm at. So that's how I like to use Crunchbase. You can also, if you have an investor already on board, you can plug that investor in there and see who they co-invest with. That's another pretty good way of building out your list. Lots of other places to build that target list of 100 to 200 plus names. PE Hub, Inside Venture, and Venture Pulse. These are daily newsletters you can subscribe to. They're free. And basically, they just report when a new startup raises a new round, they report it, right? So I spend 5-10 minutes every day with my coffee kind of skimming these newsletters, seeing who's getting funded and seeing who's funding them. They also report when a new venture firm is founded or when a venture firm raises a new fund. And that's pretty interesting information because, the best fund to be pitching is someone who just raised a new $100 million round or fund and has that money to put to work, right? So that's pretty useful. Conferences can be pretty good for filling out your funnel, especially if you're in a new or emerging space like blockchain or, cannabis or drones. There's conferences that sprout up overnight. Investors love to build their brand by getting out there on the speaking circuit, right? So just looking at the agenda can be useful. Quora, TechCrunch, and Medium are just good things to pay attention to. Quora is kind of interesting. People spend a lot of time answering questions like who are the top, retail fashion tech investors in New York. Someone's probably tackled that question. PitchBook, Mattermark, and CB Insights. These are paid databases. I actually have a subscription to PitchBook. They're amazing. These databases, I think PitchBook has 300 data analysts on staff, updating the data, maintaining the data, and it's really amazing data. You can find everything you want to know about investors, startups, who funded them. The problem with them, they're very expensive. I think for a 3-seat license, PitchBook is $20K, and CB Insights I think is $50 to $100K. So if you have a friend who has a subscription, they're pretty restrictive on logins too. So if you can sit down with a friend, or maybe you have access to an incubator accelerator, it's worth your time. And then finally, mining your own personal network. I'm going to show you 2 techniques here to build your target list from your own network. Okay, the first one is using LinkedIn. Zoom in just a little bit. So here's my LinkedIn page. I'm just on a free plan, nothing fancy. Let me just do a search on angel investor, okay? Okay, lots of results, 4,000 results, and this has changed. They've changed this a bit. Interesting, they just changed this. But anyway, what I want to do is filter this by second degree. and then typically by a location. Those are the two main things I will filter by. Very interesting. They just changed this since last week. Okay, but now look, I've got 520 results. So this is 520 people who have the word angel investor in their title that I have a second degree connection to or mutual connection to, someone in between us that are in San Francisco Bay Area. So theoretically, I should be able to reach any of these people through a mutual connection. Then what I want to do is make sure they're actually relevant for me. So I will just right-click each link, open in a new tab, and I'll end up, opening 50 to 100 tabs at a time. And then I just quickly go through each one, spend a minute on each profile. And if, Joel Englander looks good, like he invests in SaaS or SME software, I add him to my funnel. So that's how to mine your personal network. Another way is using our tool, Foundersuite. I'll just show you what I do here. I don't know how well you can read my board. This is my investor board. These are all my investors in my funnel. But notice I have a column here called Steve B. Leads. So I created this column, 3 little dots, you can create a column. Created this column, and then I invited Steve Bennett, one of my advisors, into my account. And you can do that over settings. And this is free, it doesn't cost anything. So I invited Steve into my account. I said, Steve, can you add some people from your Rolodex to my investor board? And he did. He added 15 or so names. And I did this same approach with 4 or 5 other advisors and ended up getting, 50 or 60 good, solid leads by having a structured way of asking my advisors and network to open up their Rolodex, right? It's much more structured than just saying, hey, Steve, I'm raising money. Do you know anyone? I'm actually asking him to, populate my board. So that's another way of kind of mining your personal network. Okay. The last point here, when you start building your funnel, you just kind of develop a radar and you start to see investors all over the place. We talked about this using LinkedIn. So now that we've built this target list, step number 2, we actually want to start removing people from this list. Back to the B2B sales metaphor, right? The best salespeople don't just chase every prospect. They qualify them, they prioritize them, they rank them, they spend their time well, by pursuing the right targets. And we want to do this with our investor list as well. So anyone who's invested in a competitor, you should not talk to. If they're ethical, they won't talk to you. If they're unethical, they'll send your pitch materials to the competitor. Easiest way to look at that is just by looking at their portfolio section on the website, if they're a firm or if they're AngelList portfolio. Number 2, no dry powder. This applies to venture firms. If a venture capital firm has not raised a new fund in the last 2 or 3 years, they're probably only doing follow-on deals to their existing portfolio companies. And so it doesn't mean you should not meet with them, but I wouldn't waste a lot of time with them. You might put them lower down the list. Same with angels. Actually, before we move on to angels, with venture firms, obviously the best venture firm to pitch is someone that just raised a new fund. The worst is someone who hasn't raised one. They might be a zombie fund. Angels kind of similar, right? Angels kind of go in a pattern where they decide to become an angel. Maybe their company had an IPO or something. They got some wealth. Decide to be an angel. They do a lot of deals in a fairly condensed time frame, and then they take a break to digest those deals. So if you look at someone's, AngelList page and all their deals are from 2014, they might be taking a break. Still doesn't mean you should not talk to them, but you want to surface the most highest priority investors. Wrong sector, wrong stage, and wrong geographic location. So this should be pretty intuitive, right? If you're a fintech startup, you would not be pitching a medtech investor. Stage sometimes is a little confusing. You're early, you want to grow, and you see a company or a fund calls themselves growth capital. That sounds good, right? Growth capital actually means later stage. So you have to kind of learn the parlay a bit here. Wrong geographic location. This is changing. Even 10 years ago, when I was helping companies raise money, a lot of investors who were very specific to their region, right? And now a lot of investors are investing outside their regions and even investing internationally. Best way to figure out if they do deals outside their region is just to read their website. Most of them say, we invest in Pacific Northwest software startups, right? They're pretty specific because they don't want to be getting a lot of false targets coming in the door. And then bad reputation. I talk about this as a sales process, but really it's a marriage, right? The investors that come onto your cap table, they're going to be there for the next 4 to 7 years of your life, sometimes longer. So you want to be picking the right partners. It's really a marriage. And there are some kind of bad, unethical actors out there. So 2 sites I recommend. One is called thefunded.com. It was started about 10 or 11 years ago. It's looking a little outdated, but it's kind of like a Yelp for VCs. It's really interesting to read. The other one is a newer one called knowyourvc.com, which is a similar concept. It's easy to fall into the rabbit hole of reading all these kind of juicy reviews of investors. The only caveat I have is most of those were probably written by founders that got rejected. So have some, grain of salt with it. But in general, we built that list of 200. I usually tell founders we should be removing 25 to 30%, filtering out this list. So the ones that remain are really good, high quality targets. And the reason that's important is fundraising takes a lot of time. So you want to be pitching investors that are really relevant. And why that is important is because so much of the whole game of fundraising is about getting momentum going on your deal. And you're never going to get momentum going if you're pitching like bad targets. You waste a lot of time. So this is important work. Don't skip the qualifying step. Okay, gotta take a quick drink here. So now we need to figure out how to reach everyone on this target list that still remains. Most of this is done in LinkedIn. If you're using Foundersuite, we've tried to collect their LinkedIn page, or you can just plug, Tim Draper as your target into your LinkedIn, and you see if you have any mutual connections in common. If you have multiple mutual connections, there is a hierarchy of who to ask for the introduction. The first and very highest on that list is someone that's made Tim money in the past. Tim will take that introduction all day long, every day. When I was raising money, my kid is in preschool, and I got to know a couple of dads, and one guy had just sold his startup for $640 million to Yahoo. And he offered to make like 5 or 6 introductions for me, and every single person he introduced me to responded to me within 10 seconds or less. It was the most amazing, strongest signal I've ever seen. Of course, we don't have too many of those, but if you can find one, that's pretty golden. Number 2 on the list, in terms of hierarchy, is someone that Tim has co-invested with in the past. This could be an angel that feeds Tim deals or another VC that he's done deals with. Number 3 on the list, and this is actually pretty important, is someone that Tim has invested in, a portfolio company founder. Tim has done the due diligence on that person, built up that level of trust, right? So that's a pretty strong signal. Number 4 on our hierarchy list are what I call the professional connectors. These are the guys and gals who work at the large law firms or accounting firms, and they know everyone, but they make a lot of introductions. So sometimes their signals are not, super strong. Where are we at? 5th on the list is someone that Tim met at a conference 2 years ago, and they connected, but they don't really know each other. It's a pretty weak signal. And then lastly, if you have 0 mutual connections, what do you do? This is one of the most common questions I get. The best thing you can do is to look at Tim's portfolio of current companies and reach out to a couple portfolio company founders in a very kind of casual, informal way. Like, hey, I see Tim invested in you. I really like what you're doing. I'd love to hear how it's been working with Tim. Is he active? Is he involved? And you get a rapport, a dialogue going with a founder. It's okay to ask for the introduction to Tim because most founders are pretty good about helping other founders. They've been in your shoes. They know how painful it is to raise money. And on the other side of the table, Tim has that trust level with that founder, right? It went through the due diligence. They trust each other. So that's a really good way of kind of networking your way into an introduction. It takes a little time, yes, but it's pretty important. Should you do the cold email? The other common question. I've seen startups try cold email approaches. I've never seen it work. I've never seen anyone get funded through a cold email to an investor. The reason is, right, it's very easy to find people's emails today. You can look up Tim's email instantly using a number of tools. The reason it doesn't work is because Tim is already getting 50 to 100 warm introductions a day from people he knows and trusts in that hierarchy list. So your cold email, if he even opens it, already has kind of a negative stigma to it that you were not willing to take the time to network your way into an introduction. They filter their inbound deal flow by introduction. So I strongly recommend doing the cold email approach, although I have done them in the past myself. If you're going to write cold emails to the investor, just make sure it's a really personalized, short but personalized email. Okay. Now we want to, so we've built the target list, qualified and filtered it, mapped all our connection paths as best we can. We're just about ready to go actually, start our round and really get out there. But first we need a way of tracking all this interaction and discussions that are going to happen. I used to build these very elaborate spreadsheets for my clients when I was a consultant. And of course, here's my little product placement, but that's what led us to build Foundersuite as a better way of, tracking your funnel and really running a process. And so I'm just going to show you a couple quick tips on this. The structure of course is like a funnel, right? We've got research, new, contacted, pitch, diligence, committed, or said no. And basically when you're fundraising, your job is to be moving all these cards through the stages of fundraising. And practically speaking, that means I come in and I'll look at everyone in the contacted list. And I say, all right, I've already been connected to Brad. A friend of mine made an introduction. What can I do to nudge that along and try and get him to set up a pitch meeting, right? And same with, Naval. I pitched him. What can I do to nudge this further and get into diligence, right? Is he waiting on me for stuff? What are the actions I need to take to kind of get this moving down my funnel? Or, hopefully to a committed or to a no, right? Moving people into the no at least flushes them through your funnel. And the corny joke we always make is, this is like a chess game. You're moving all these pieces from left to right. And if you move them all into the committed column, you win the game. If you move them into the no column, you just lost the game. A couple other very quick things I'll show you. I add my own custom columns because I have kind of my own style of fundraising. Like I added a column where I collect all my connectors. This is the guy that actually sold his company. He was really great. There's Steve. And then I have a column called qualified and mapped. This is where I move people after I've qualified them, meaning they invest in my sector, my stage. And then mapped means I figured out a mutual connection to reach them. Let me just show you like a couple other quick little hacks. One thing I think is important is having an owner for every prospect, right? So you can assign owners. You need someone who's ultimately responsible for driving that investor to a yes or no, right? That's the owner. In terms of activity, every, pitch or meeting you have with an investor usually leads to 2 or 3 follow-up action items. And so when you're talking to 150 investors, it's just a huge volume of actions and tasks and activities. So, I suggest logging it here and then pushing it out to the calendar of your choice so you're staying on top of everything. You don't want to be anything slipping through the cracks. That's the death spiral of a fundraise when things are slipping through the cracks and the round starts to take too long. Other thing is you can attach files. So this is useful, like what's the term sheet you sent this guy? Attach it here so it all becomes part of the record. And lastly, with emails, you can connect your Gmail or BCC the system so all the email threads with this guy gets pulled in. So really what this is doing is creating that system of record for all tasks, notes, meetings, files, emails with that investor, right? So that is my little product placement. Thank you for listening. Okay, next, step 4. We haven't quite started reaching out to investors yet. This is sort of the last step in the process before we really go for it. And just the only key point here is really before getting out there and talking to investors, make sure your pitch deck is amazing, really amazing. Excuse me, I always tell founders, make sure you've given your pitch at least 5 to 10 times to people who will give you hard, honest feedback, or, rip you apart. Because you don't want to get out there with a crappy pitch deck. I see this as one of the number one preventable reasons why people don't get funded is they go out with a bad pitch, right? And the thing is, you can't go out and pitch an investor and then come back 2 months later and try and do it again. They won't. That's not how it works. You can't do that. Plus, you're burning your social capital if you go out with a bad pitch. So make sure your pitch is really good. Actually do offer a once a quarter 30-minute pitch deck review for our paid subscribers, not for everyone, just our paid subscribers. But, just get a second set of eyes on your pitch deck if it's not me or one of us, someone else. And then your model. The model is the other important thing. If you're going out to raise $1 million, make sure you can detail very clearly how you're going to spend that and where it's going to get the company, right? And even better if you can show a business model and what that looks like at scale. So your pitch deck, your model, and then usually I'll put together like a one-pager as well. Okay, now it's showtime. You gotta take a drink of water. So now it's showtime. We're ready to actually, go for it and raise this money. This is the email I used. Let me back up. When you're doing the research phase of figuring out how you're connected to all these investors, a lot of times you find that a lot of the roads lead through just a couple people. I call them the power connectors, right? And Jeff Thomas is one of my power connectors. He works at NASDAQ and knows just a lot of people. And when I was doing the research, I noticed a lot of people he was linked into. So this is the email I sent to Jeff saying, hey, Jeff, do you know these people? Do you know any of these people well enough to make an introduction? And he can just respond saying, yeah, I know Tom, I know Jessica, I know Wesley, I don't know Kyle, Noah's not doing deals anymore. He can respond to this just yes, no, really quickly. He can be reactive to it. Now contrast this to that very first slide I showed you of how not to do this, how not to raise capital. If I went to Jeff and said, hey, Jeff, can you introduce me to some VCs? He would have to think about his entire network, his entire Rolodex, and he's got like 800 people in his network. You have to think about that, and it's just too much work. Whereas being reactive, this takes him 5 minutes. So for every person that he says, yeah, I'm happy to introduce you or connect you, I put together a new clean email thread that looks like this. And notice how short this is. This is not, a half page or 2 pages of text. Very short. Subject line is very important. Jeff, can you introduce me to Target? Clint is the target investor or prospect. And then, what are we doing? We're raising a seed round. At this point, we had a lead investor, FFDC. They're a venture firm. And we had 2/3 of the round committed. So I put that in the subject line. If I didn't have a lead investor, I would put whatever is the single most exciting, sexy metric or fact, data point in the subject line. Whatever's most exciting about our business, I would put it in the subject line because you want your email to get read. Remember, these guys are getting introductions all day long. Their inbox is flooded with them. So you want to make sure they open your email. Okay. Jeff, good chatting with you. I'm raising a seed round for our investor management reporting platform. This is what we do. And then if you want to check it out, you can just go to our webpage. And then the ask, can you introduce me to target investor? And then the why. He's got a really good track record. And then I noticed on LinkedIn that he went to this very small college in Iowa, same one my dad went to. So I I put that in here just to personalize this a little bit. Obviously, I don't do that with everyone. And then I include a link to our deck, and our deck is hosted up on Foundersuite. This is a teaser deck. This is not the full deck. This is like, I forget how many slides it was, but maybe 6 or 8 slides, high-level overview of what we're doing. And the reason I include this teaser deck as a link is I want Clint to click on it, check it out, and if we're not a good fit for his thesis, his investing thesis, I'd rather him opt out up front versus taking time, setting up a meeting, driving down to Mountain View, having a meeting. You can chew up half a day just on one meeting in many cases. So I use the teaser deck as a way to additionally qualify these investors, right? I hope that makes sense. Basically, though, for Jeff, my connector, all he needs to do is click forward. Hey, Clint, do you want to take the introduction to Nathan? He's a good guy. Send. He can do the opt-in approach. He can fire off, 5 or 6 or 7 introductions in 10 minutes. Boom. I'm making it easy for my connector to do his or her job. Super, super important. The flip side of that, I get people asking for introductions all the time. I'm like, oh, sure, I'm happy to, and they'll send me a pitch deck and like 2 pages of text about their business and a whole bunch of links, and they want me to assemble an email for them. I can't do that, right? I'm happy to forward something along in most cases if you've qualified that investor and it's a good, relevant fit. Okay. So now, it's game on, right? The curtain is up. We're out there asking our connections for the introductions. We need to go into hustle mode here. I love this show, Silicon Valley on HBO. I'm sure, most of you have seen it. This is season 1. Richard's the CEO. He's an introvert. He's an engineer. He wants to be writing compression algorithms, but instead he's got to get out there and pitch all these investors. And these investors are all really smart. They all went to Harvard and Stanford. They're all successful. That's how they became investors. They often have very big egos in many cases. They think, they know it all. And this is what they do all day, every day. They're professional investors. Whereas for Richard, it's his first time at the rodeo. So, even though it's not his nature, he's got to, as I call it, channel your inner hustler and get out there. And, it can be really stressful, but it can also be pretty fun if you kind of think of it like a game. So that's the takeaway from this slide. Couple hustle tips. Number 1 here is doing the intros in parallel. We call this the blitzkrieg approach. Basically, we're asking our connections. We did the research. We know who to ask for the introductions. Then we're asking for the introductions from our connectors all in the same kind of time frame. Call it the blitzkrieg approach. What we're trying to do is get momentum going. Every time you have a meeting with an investor, they'll always ask you, so how's the round going? How's the round coming together? That's their little probing cue to see if you have momentum or not. And to the extent you can answer that question with, we just started raising. I've got 10 meetings set up this week. I've got 12 next week. We're running a pretty tight process using Foundersuite, of course. To the extent you can signal that you have a lot of meetings set up in a pretty condensed time frame, that shows that you have momentum. It shows that other people are interested in the deal, and they should probably pay a little bit more attention to this, right? Because investors' natural inclination is to just watch and wait, right? If a deal has momentum, they're forced to act faster, And so much of your job is really trying to build that momentum around your round. Very, very key. And you kind of know it when you see it, right? You sort of feel it when you get momentum going and your confidence picks up and that momentum kind of builds on itself. So it's harder to do than it sounds, but that's your kind of job to get momentum going. Regarding your pitch, you should be constantly improving your pitch deck. When I was raising our round, I would go, pitch a couple of investors, have a couple of meetings, then come home, put my kid to bed, pour myself a nice cocktail or crack a beer, and then I'd spend an hour on my pitch deck every night. based on the feedback I got from the pitch meetings during that day, right? And sometimes I would have someone else with me in the meeting to take notes. And so I'm doing this until my pitch deck is just getting better and better throughout the entire duration of my fundraise. I think when we finally raised our round, I was on version number 42 of our pitch deck, literally version number 42. But the thing is, I'm building momentum in our round, and our pitch is getting better and better. And so these things kind of amplify each other. Okay, leveraging VCs off each other, that kind of ties back to the momentum thing. And then this last part here, very few founders do this, but it can be one of the most powerful things you will do for your fundraise, and that is to send a regular progress update to the people in your funnel. So here's, put this in bold caps. Everyone in your funnel who has not told you no should be getting a monthly progress update from you. And it doesn't have to be long. In fact, the shorter the better. I mean, half a page to a page is pretty good. But everyone who has not told you no should be getting a progress update. And the reason this is important and why it works is because two things. One, you're showing steady progress, right? Investors don't invest in just a dot, they invest in a line, as the saying goes. So you're showing progress, and you're showing that you can communicate. Every investor has put money into a startup and then never heard from that founder again until the company is almost out of money. They hate that. They hate that more than anything else. And so you're showing, even before they've written you a check, that you can execute and you can communicate. And so this is my very last little product placement thing, but I'm just going to show you. We built a tool for this, of course. Why don't more founders do this if it's so powerful? Because it just takes some time and effort, right? So we're approaching this from kind of the minimal viable. What's the minimal viable update you can do? So we have 6 different sections. We tell you what to write for each section. You can build a KPI table really quickly. It looks good. If you've got a cool product or maybe a team shot, picture, put that in there. Actually, I'll just make one little quick note. If you're doing this for prospective investors, you would remove the challenges section. And you would probably remove the how you can help because they're not on your cap table yet. So you'd remove a couple of these sections. But basically, you create a little update, you publish it, and I'll just show you what this looks like. I have an old one here. So this is what it looks like. So it generates a URL. You send that URL out in your own email. Pretty soon, you'll be able to send it from the system. We're working on that right now. But currently, you send it from your own email. The investor comes to the site. They see your update. It looks good. It just looks nice and clean. There's a nice, clean KPI table. And it just makes you look professional, right? That's the kind of point of doing it like this. But the cool thing is you can track and see which investors, if you mark it private, you can track and see which investors opened up and looked at your deck. And not shown here, let me see if I have it here. We just added a new feature where you can also track how many minutes they're spending on your materials. So that's kind of cool to see who's like really interested and who's not. The other thing you can do just while I'm here, very last bit, is you can use this to host your pitch deck. And so, again, you put your pitch deck up on here, create a link, and then you send that link out, and same thing. You can track and see which investors are looking at your materials. So that is, you're number 41. That is the last of my product placement. Thank you for listening. But anyway, doing the investor update is pretty powerful. Last point here on this slide is, fundraising really kind of becomes a full-time job. People hate to hear that, but that's the reality. I've been doing a podcast series interviews lately where I'm interviewing founders, and I ask them, how many investors did you talk to? How long did you spend on this? And consistently, the ones that got like oversubscribed rounds, they were doing it full-time, 10 hours a day. I mean, it's hard to do that, but that's kind of what it takes, right? Because again, we're trying to get momentum going. you can't really get momentum going if you're putting in, 3 hours a week on your round. What happens is if you're part-timing it too much is it starts to get stale, right? You never get momentum, and then the deal starts to get stale. So the more you can give some of your duties to your co-founder or someone else, and you can really concentrate on fundraising, the better. I know that's almost impossible to achieve in reality, but that's what you want to aim for. And then lastly, it's really, really stressful, as I'm sure many of you know already. When I was raising our round, about in the middle of it, I was waking up probably 3 or 4 times a week, like in a cold sweat at 3 a.m., and I couldn't get back to sleep. Or that just happened all the time. I thought I was getting an ulcer. I even asked my dad for a prescription for ulcer medicine. Turns out I didn't have an ulcer, but I thought I was. That's how stressful it was. And I had been doing fundraising for a while, right? Just keep in mind that's normal. If you're about to jump off a cliff, give me a call and I'll talk you down. Okay, a couple more little tips here, getting towards the end. Get a drink of water. So we did some retargeting ads, basically using Facebook ads to all the investors we were talking to. I don't know exactly how efficient it was, but it didn't cost us very much money. And one of my angel investors said every time he logged into Facebook, he saw Foundersuite's logo, some ad for us. And so he did write a $70,000 check, so maybe it had some subliminal effect. But really what we're doing with retargeting and with the monthly update that you're sending, and if you can generate any PR while you're fundraising, really what we're trying to do is stay top of mind with the investors, right? These guys are getting 50 to 100 introductions a day. They're meeting with 25 to 30 companies a week. So you're just one little blip on their data, on their radar, right? Your data amongst noise. And so we want to kind of rise above the noise, right, by retargeting, monthly updates, and PR. Number 2, we've kind of already covered. I use, our own platform to host our pitch deck, but there are a lot of other ways to host your pitch deck online, like Google Slides and stuff like that. The reason is 2 things. 1, we can track and see who's actually looking at our materials. The other thing is, when I put my pitch deck up on there, I go and every night I'm improving certain slides, right? And so even if I sent an investor that link 3 weeks ago, my deck has evolved already since then. And so the online version is always the latest and greatest version. Contrast that to if I attached a PDF of my deck. It's already outdated, right? So that's why I like doing your deck online. Number 3 here, some people suggest using Facebook. The theory is maybe it's stronger signals if you have a mutual Facebook connection. I know I have like 3,000 LinkedIn connections and like 300 Facebook friends. So, there's kind of a signal there. AngelList is something that comes up a lot. What is AngelList all about these days? They've been kind of changing. They seem to be very focused on syndicates these days. Syndicates, if you're not familiar, is basically an angel investor who has backers behind him or her, and collectively they can write, $200,000 checks. Really, the only takeaway I have is syndicates are good to fill out the last portion of your round, not so good for initiating your round. So if you already have, 2/3 of your round full, go look at angel syndicates. Angel groups are another question that comes up a lot. If you go to angelcapitalassociation.org, I think it's, just Google that, you can get a list or directory of angel groups. There's like over 1,000 around the world. Here in the Bay Area, we have at least half a dozen angel groups. The advantage of angel groups is you can pitch, 50 investors in one shot. The disadvantage is it takes a long time to get in front of them. There's usually an application process, screening committee. It can take, multiple steps before you get there. Crowdfunding is another one that comes up, and talking about equity crowdfunding, not so much Kickstarter. People I know that's done crowdfunding say it took as much time and effort as it would to if they had gone out and raised, from angels and VCs. So crowdfunding is not like a silver bullet for your fundraising. It doesn't mean you shouldn't explore it. I think some of these vertical crowdfunding sites, like if you're in consumer products, there's one called Circle Up, or video games, there's one called Fig. I think they're kind of more interesting because they've done a better job at like corralling investors. And And then lastly here, talking about scarcity, it taps into that whole fear of missing out, right? So if you've got $300,000 in friends and family commitments, sometimes it makes sense to go out raising like a $500K round because now it looks 2/3 of the way full. And then as you start to fill that up, you increase the amount you're raising. So your round looks, 2/3 full all the time. So it's signaling that scarcity. I wouldn't overgame this, but it is kind of an optics thing that does have an effect. Okay, almost done. So we've been out there fundraising, getting the introductions, having great pitch meetings, improving our pitch deck. We've been out there for a month or 2 or 3. Now it's time to try and close this round and, get those checks. Every time you have a pitch meeting, you need to do a couple things. One is don't walk out of there until you've asked for their interest level and next steps. So it's like, hey, really great meeting you. I love telling you about our vision. I'd love to hear, what's your interest level in our deal? What's your typical check size? And what are next steps? What's your process look like, right? Those are the things you want to ask. And they usually give you kind of a generic answer, I need to go talk to my partners about this at our Monday deal meeting. But to the extent they give you an answer like, let's have you come in next week. If there's a next step in the answer, that's a good buying signal, okay? So always ask those questions. You want to really gauge their interest level. Number 2 is make them actually chase you a little bit. So again, don't walk out of that pitch meeting until you've said something like, hey, I love talking about Foundersuite. I'd love to hear how you work with your portfolio companies. Are you active or, or not? And in particular, how would you help me build Foundersuite, right? You make them pitch you a little bit on how they would get involved. And the reason this is pretty powerful is because every investor has lost out on a competitive deal where there were more investors trying to get in than there were seats on the cap table. And so you're kind of signaling that it's not an automatic that they can get into your deal. They might have to actually work to get into your deal. It can have a kind of powerful effect, especially as you generate momentum on your round, making them kind of pitch you really starts to add on to itself. The more confident you get, the more, this becomes a thing. It takes usually at least 3 meetings before you can get to a yes or no, sometimes even longer than that. But if you're on meeting number 7, especially with an angel investor, they might just be a tire kicker, not serious. And of course, so much of the work is focused on getting that first term sheet, that first lead investor, because once you get that person, you can go around to everyone else in your funnel and say, hey, we've got a term sheet, are you in on this deal or are you out? You can kind of use it as a catalyst. It also takes, usually at least a couple months, sometimes as long as 6 or 7 months. If you're still fundraising 8 or 9 months down the road, something might be wrong. So you might take a break. It's hard to get a no from investors. Point number 4 here. A lot of times you'll have a great pitch meeting, and then you follow up, a couple days later, and you just never hear from that investor again. My rule, we call it VC ghosting, right? My rule of thumb is if I've sent 2 or 3 emails and not got a response, I actually move them into a column. Kind of funny, actually. I'm just going to show you. I move them into a column on my board called no response because it's the same thing as a no. It's just not a hard no. Where are you? There you are. So yeah, I added 2 extra columns. I have my hard no, and then I have a no response column. This is where I move people who stop responding to me. And then, you get a lot of people say, oh, I like you, but you're too early for our fund. So I have this revisit for Series A. So that's another version of a no. Anyway, it can be hard to get a no, but that's kind of your job is push everyone to a yes or no. When someone does say yes, we use Paul Graham's handshake deal protocol. Basically, all this means is you're out at coffee. They say, put me down for $50K. So then you go back to your computer after the meeting and just say, hey, really great meeting with you. Just to confirm, you're in for $50K. Please write back confirming that. If they do that, write back and confirm, then you can pretty safely consider them a commitment. If they don't do that, they're still just a prospect or lead and should be treated as such. And then very lastly, just keep on this until the wires actually cross your bank account. I've seen this pattern, this terrible story, numerous times, dozens of times, where the founders get out there, start fundraising. They're all excited about it at first, and then 2 months into it or 3 months into it, they're just tired of that rejection, right? They're sick of getting rejected constantly. Their customers are pulling them, in certain directions. They're just kind of getting pulled away from the fundraising. They take their eye off the fundraising a little bit, and then an investor drops out, another drops out, and the whole round collapses. And the company sometimes even doesn't survive that. So I've seen that happen many times. So if you're going to raise money, just keep your foot on the gas pedal all the way until those wires are done. You got to sprint. And then last thing here, keeping in mind, this is, and we can open up for Q&A, so be thinking of your questions. This is just the start, right? You just raised $1 million, which is amazing. I'd love to hear about it, especially if you use our platform. You raised $1 million, that buys you maybe 12 months of runway. That really means you need to start fundraising again 6 to 9 months from now, right? So, you've got an obligation to perform. I'm going to email you guys the slides. Of course, please check out Foundersuite. And then we have a Funding Hacks group on Facebook. You have to apply, and I'll just, mention that you found it on here. The only reason we have people apply is just to keep out kind of like service providers and spammers and stuff. So I'll let anyone in, just maybe make a quick little note in the application. It only takes like 2 seconds, but it's kind of fun. We've got people talking about fundraising, sharing links, stuff like that. The last thing I'm going to plug very quickly, and then we'll do Q&A. I'm super excited about this. We're going to announce it on next week. We started this podcast called How I Raised It. So I've been interviewing different founders. We've got about a dozen of them so far, different founders who've raised money. And we just go into the nitty-gritty, the details of how they raised their rounds. And there's a lot of just really good content. So you can actually find this on iTunes if you search How I Raised It. We haven't announced it yet. We're going to announce it next week. But if you want to listen to a couple tracks, you can find it on iTunes or SoundCloud. That is the talk. So let me see if there are any questions. Thanks, guys. Any questions? I hope you're still there. Any questions at all? And if you don't mind, if you have a question, okay, there's one. If you don't mind, if you have a question, just type it into this little chat window. Again, I need to keep everyone muted. But good question. What's your advice for Series A raise? So almost everything I just described here applies. The only main difference with a Series A is you typically would not have 200 investors in your funnel. You would probably have more like 40 to 50, right? So it's a smaller kind of total pool. And of course, you need to, the other difference, of course, is finding the right firms to pitch and then really narrowing it down to the right partner at each firm. So it's kind of another layer of research there. But yeah, I mean, I've interviewed and I've worked with companies raising Series A, and still you need a pretty healthy funnel. 30 to 60 maybe is the range of targets. Spend the time qualifying them, researching them, and then the rest is the same advice. Run a process, get some momentum going, and then, really going for the close. The other thing about maybe a Series A that I'll just mention briefly, that typically comes with a board seat, right? So sometimes when you're raising an angel round, it's not, when you're raising an angel round, you might not have anyone join your board, kind of depends, but Series A, you'll almost certainly get some of them on your board. Okay, viewer number 28, how much did you pay for those Facebook ads? Yeah, I mean, like $500 total. I think we spent like $500 on Facebook retargeting ads over, 2 or 3 months. It really was just not that much. Yeah, good question. Any other question? When did the investor cut the check? Well, so when did the investor cut the check? I mean, the investor cut the check when let me give you the very short story of our round. So I went out starting to raise $500K. I went out starting to raise $500K as a convertible note. And I was talking about angels and seed VCs. And then when I got one seed VC saying, we want to come in, but we want to do a priced round, not a note. We want to do a priced round. We want to put in $500K. Yeah, I'm getting to your question. We want to put in $500K, but you need to go raise at least another $250K from other parties. That was the seed investor. So then I had to go out and raise another, half the round from angels. So that's, I started to corral these angels. And then when I finally crossed that mark of over $250K from other parties, then we could have a closing. And that's when the guy wrote his check. So some people do a rolling round if it's a convertible note, or say other people have, here's the round and here's our closing date. That's what we did. Okay. Our excellent advice. You really showed your depth. Thank you very much. Not enough product placement. That's funny you say that. I try and not make this too much of a commercial, but I just, our product seems to be helping people, so I like to show it off. Thanks, Phil. What goes into the teaser deck and final deck? Yeah, so the teaser deck, I would keep it pretty high level. Here's our business. Maybe, a good team slide, a good team slide. The teaser deck doesn't really have like roadmap or any really proprietary information. Usually you'll have your metrics if you have some good metrics. If you've got a growth story, tell that growth story in your teaser deck. The full deck is a little bit different. Usually it's still a pretty high-level story, but then you might have, 10 or 20 or 30 appendix slides that go into more detail on, questions are likely to be asked. Actually, I'm going to make one more product plug, kind of. In addition to the podcast, we have this blog, and at the top of the blog, just speaking of pitch decks, is we have a really good pitch deck guide. So if you download this Ultimate Pitch Deck Guide, you're looking for some tips on pitch decks, that's where I recommend checking out. And once again, that was just blog.foundersuite.com. And top of the page, Ultimate Pitch Deck Guide. Okay. Yeah, thanks. I appreciate the best kind of commercial. Do you have any recommendations on how to position a seed plus raise? Oh, that's a great question. So there's a really interesting, I don't want to call it the valley of death, but there's kind of a place that startups find themselves in between raising a seed round, but when they're not yet ready for a Series A round. A lot of startups fall into this kind of valley, right? Maybe your metrics aren't what they need to be to raise a Series A, but you need to go raise more money. I was kind of in that space ourselves like a year ago, and we labeled it Seed Plus. I think we labeled it Seed 2. We called it all kinds of things. I think I've even seen startups relabel their first thing as a pre-seed and then label their newer one as a seed round, like kind of like changing history a little bit, revisionist history a little bit. But anyway, and you've seen this more and more where startups have to raise kind of this seed plus, seed 2, et cetera. You have to kind of position it. It's a hard one. It's a really hard one to raise, even if it's not that much money. You have to kind of position it as, look, we raised that money. This is what we've learned and built. This is what we've done, learned, and built on that money, right, that we raised previously. And here's why it's still worthwhile to put money into this. So a lot of it is, hey, we put our MVP, we got some growth going, we learned a few things we were doing wrong, but now here's why we're ready to scale. Because even pretty much at any pitch round, you're selling this vision for the future. So I think that's how I would approach it. It's really kind of lessons learned, takeaways, and then an exciting growth story even if your metrics aren't all there yet. Oh, and any tips for startups looking for pre-seed? Yeah, pre-seed a lot of times becomes the pitch focus. Let me start over. At pre-seed, a lot of times the pitch becomes focused on team and vision, right? And that's kind of what you're selling. You don't even necessarily have a product or traction. You're selling a bet on you guys and where this could go. So again, both these scenarios, the main focus of your pitch is on the vision for the future. The only difference is at the pre-seed, a lot of stories on team and concept, whereas the seed plus, it's team, concept plus, here's what we've, how we've increased the value and what we learned from the earlier round. Awesome way to convey a very complex process. Well, this is kind of our whole goal with Foundersuite and everything, is to make this more streamlined, make it more, efficient, really, because there's a lot of time spent wasted fundraising. Good stuff, guys. Good stuff. Any other questions? Suggestions on priced versus non-priced round. A non-priced round, if you're not familiar, would be something like you're doing a convertible note, or SAFE in some ways. A convertible note where you're really pushing off the valuation to the next round. They're a little bit, quicker in many ways, because a price round, you've got to get into negotiation. It kind of comes down to how much momentum you have, how much interest you have in your deal. If you have a lot of parties interested, then, it can actually be in your benefit to do a priced round. We did a priced round. I'm happy with it. I got some good investors on board, but non-price can be a little bit quicker. Okay. Foundersuite looks good. I will be using it for sure. Thank you. Do you have data from investors like CB Insights? I am not a subscriber to CB Insights. I get their newsletter. They've got a pretty good newsletter. They're very expensive. I do subscribe to PitchBook, and it's really amazing data. It's just restrictive. I've got one license, one seat. Even my teammates who are in other places cannot log in on my account. Like, only I can look at it, It's kind of pretty restrictive. They have a startup pricing, but it's very expensive. The data is just amazing, though, and I think CB Insights is probably similar. Good stuff. Any other questions, guys? Otherwise, I will be sending around this talk. I do appreciate all the questions, by the way. Good. All right. I think I've expelled enough air here. If you think of a question later, you can always just email me, Nathan at Foundersuite, and definitely check out Foundersuite, check out our funding hacks, and go into iTunes and look at how I raised it. I'd love any feedback on this. I'm excited about launching that. Have a great weekend. Thanks, everyone. Appreciate it. Bye now.